Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we've seen overnight. Global stocks rising as easing bond yields have moved amid anticipation of further interest rate cuts. Spurring investors on Wall Street, all major indices finishing strongly. The S&P 500 posting a closing record high as labour market data reinforced investors' views that interest rates will fall. Stocks specifically Broadcom edged higher in after-hours trade following the release of its results, forecasting fourth quarter revenue above estimates, banking on strong demand for its custom AI chips as enterprise clients invest heavily in data centres and machine learning applications. Other mega cap tech stocks rose, including Meta and Amazon. JetBlue Airways, it expects a smaller decline in its third quarter operating revenue. It also said it will partner with Amazon subsidiary Project Kuiper, a low Earth orbit satellite broadband internet network, to improve its onboard Wi-Fi. Salesforce shares fell after the company forecast third quarter revenue below Wall Street estimates, signalling lagging monetization for its AI agent platform. T. Rowe Price climbed after announcing a deal where Goldman Sachs plans to buy up to $3.5 billion of its stock. In the retail space, American Eagle Outfitters shares jumping 38% after the apparel company forecast third quarter comparable sales above estimates, whereas shares of athletic wear maker Lululemon fell about 13% in extended trade after lowering annual sales and profit forecasts. And Atlassian has bought the browser company for $610 million as it moves into the AI-powered web browser market. Well, US private payrolls increased to less than expected 54,000 jobs last month amid easing labour market conditions. And the number of Americans filing new applications for unemployment benefits increased more than expected last week. This as the Trump administration urges the Supreme Court to swiftly hear a bid to preserve its sweeping tariffs, which have been ruled illegal, striking a deal just in the past hour or two, in fact, arriving at a 15% tariff for Japanese exports. Meanwhile, China has imposed further tariffs of its own. It's applying tariffs of up to 78% on US optical fibre imports from September 4th, accusing American producers of skirting anti-dumping measures. US Treasury yields have fallen, with the 2-year and 10-year notes dropping to 4-month lows following the jobs data. The 2-year at 3.58%, the 10-year around 4.16%. Markets pricing in a 90% chance the Fed will cut rates by 25 basis points at this month's meeting. And the US dollar rose, while the Aussie dollar, it has tumbled around 0.5%, currently at 65.2 US cents. And Bitcoin having fallen back to around 110,000 US dollars. Oil prices have eased to a 2-week low on an unexpected build in US crude inventories and on expectations that OPEC Plus producers will increase output targets at a meeting this weekend. Brent crude futures down 1% at $67 a barrel. Copper fell 1.5%, whereas iron ore rose 1.5% to 105 US dollars a tonne. And the gold price has slipped as traders took profits following a record-breaking rally. Spot gold around $3,544 an ounce. Well, for more on US markets, let's catch up with Dave Sekera, Chief US Market Strategist at Morningstar. Dave, welcome back. Terrific to have you back on the show. Now, another record for the S&P 500. The market keeps moving. What is it? Is it all about those rate cuts that are coming? Essentially, the market's leaning into that.
Well, I think the market is definitely leading into that. And I would just say at this point, overall, the market is trading equal to a composite of our fair values. Of course, we cover over 700 stocks that trade on U.S. exchanges. And when we compare the market capital of all of those companies versus their intrinsic valuation, they're pretty close to being equal right now. But I think what's more important than just the broad market valuation is to look and see what's changing in that the last month in August, what we saw was a broadening out of returns, really moving away from those mega cap AI stocks, those growth stocks that have really largely driven returns year to date, to those areas that have lagged over the course of the year. So last month in the U.S., we saw small caps outperform. They're up, about 4.5%. Doubling large and mid cap stocks, which were only up about 2%. Value stocks finally seemed to catch a bid. They're up over 5%, and growth stocks were only up 0.4%. So I think what we're really seeing is, just how much, the market is now starting to broaden out, which is what we expect to going forward. In fact, I think over the past year, on our interviews, I've just consistently been highlighting how undervalued small cap stocks have been, both on an absolute and relative value basis. But, I was always cautioning investors, this is a long-term investment. This isn't a trade, not to expect this, to really start to outperform until later this year. So now that we are seeing this outperformance, the question I'm naturally getting is this the real deal, or is this a head fake, or is this rotation, starting too early? So small caps are the most undervalued part of the market, trading at a 15% discount even after this rally. And that's still on a relative value basis near some of the most undervalued levels comparative to the rest of the market. Now, historically, small caps do best when the economy is reaccelerating after either a recession or a slowdown, the Fed's easing monetary policy, and long-term interest rates are declining. So at this point in our mind, we think two of those three conditions are being met. The Fed is going to start easing, at least in our view, later this month. We're looking for at least one more cut in December, and then 110 basis points of cuts, in 2026, probably mostly in the first half of the year. As far as long-term interest rates go, we're seeing the 10-year at the bottom of the range that it's traded for over the past year. We're looking for long-term interest rates to continue to keep coming down. Our U.S. economics team is looking for the 10-year to average 3.9% next year, 3.5% in 2027. So then, of course, the real question is, what's going on with the U.S. economy? But of course, that contraction was because of all the importers really trying to front run the tariffs. And then we had a big expansion in the second quarter, but that was distorted because all those importers were using up, their inventory that they had. Looking at the third quarter, Atlanta Fed GDP now is just printed at 3%. So that'd actually be a pretty strong growth rate for the third quarter. But our own U.S. economics team is still only projecting a 2% growth rate, and that to slide in the fourth quarter to 1.4%. So that third condition, I would say the U.S. economics team is still only projecting a 2% growth rate, and that to slide in the fourth quarter to 1.4%. So that third condition, I would say the jury's still out a little bit. If the economy ends up being relatively weak, I think the rally may stall, but then would start to pick back up again when the economy is poised to reaccelerate. So with those small cap valuations where they are, I'd still remain overweight those today.
Dave, you make the point that up until just recently, the stock market's still very much dominated by the narrow leadership there, led by the likes of NVIDIA. Do you feel as though that then has changed, particularly in the wake of its result, its share price having come off, of course? And are there risks posed to those AI hyperscalers?
Yeah, and I mean, that is probably the biggest risk, is the AI story to the marketplace today. When you look at the market concentration, I don't believe it's ever been as concentrated as it is now. I mean, NVIDIA in and of itself is about 7% of the total market capitalization of the U.S. market. If you look at the 5 largest companies, they're a quarter of the total market cap, and the 10 largest companies are 35% of the total market cap. And of those 10 largest, I'd say 8 of them are really tied to the AI theme. Now, just let's put that into perspective a little bit. So after NVIDIA results came out, our equity analyst team did bump up our fair value to $190 a share, a 12% increase. But because their market cap is so large, that's equal to increasing their valuation by $510 billion. That's greater than the total market cap of Exxon, which is the 17th largest company in the U.S. Just think about it. That's like five $100 billion stocks that we just added, to the index valuation. Overall, there's only, I think, 112 companies with over $100 billion of market cap or more. So I think that just puts into, perspective, the risk of having so much concentrated, in the AI story, that if there's any slowdown, in AI or any other catalyst that could cause people to think that there is a slowdown, I think it'd be similar to what we saw in January after DeepSeek, hit the headlines. A lot of those AI stocks down, 20, 30, and in some cases even 40%. So that to me is still the biggest risk in the near term to the marketplace.
Dave, if it transpires, the Fed does cut this month, and your expectations there, perhaps 110 basis points of cuts to come in 2026, which sectors are likely to benefit?
Well, first and foremost is going to be the real estate sector. That's long been the most hated asset class, on Wall Street here in the U.S. Currently trades at a 7% discount, to fair value. A couple stocks I'd highlight there. First one would be Realty Income. That's a 5-star rated stock. That's our highest rating. It's a 23% discount to fair value. Provides a nice 5.5% dividend yield. That's a company that has a pretty good diversified portfolio of triple net leases. So what that means is that they're able to pass through any inflationary cost increases on their own directly to their tenants. That's the one in the REIT space that also historically is most correlated to interest rates. Our second pick in the REIT space is going to be Federal Realty. It's a shopping center focused REIT, but they own very high quality properties, very good average population density, high income areas. That's a 4-star rated stock at a 27% discount. Other than that, I'd look towards the home builders and the building material stocks. Two picks there are going to be Lennar and Fortune Brands. Both are 4-star rated stocks. I still like energy. I think easing monetary policy, if it is able to stimulate the economy, that's going to increase energy consumption. Our pick still is Exxon for the global majors, 4-star rated stock at a 15% discount. And then lastly, as we see short-term rates coming down faster than what we expect long-term rates to come down, that steepening of the yield curve should be good for the financials. Now, overall, I'd say the financial sector we think is already fully valued, if not overvalued. A lot of the large U.S. mega banks are fully valued, probably 3 stars, some of them at 2-star levels. But I would look to US Bank. It's kind of stuck in between being too large to be a regional bank, too small to be one of the big US banks. I think it's being overlooked by the marketplace. That's a 4-star rated stock at a 10% discount with over 4% dividend yield.
Dave, always terrific to get your outlook from Morningstar. Thanks so much for joining us.
Well, thank you, Andrew.
Let's return to the local market just ahead of the open here on Friday. We are expecting to build on yesterday's gains, obviously a very positive session. That was in the wake of the previous session, which was the worst since the Trump tariff tantrum in April. So SPY futures are up close to 0.6%. Stay with us. We'll get right across that in just a couple of minutes.